Rohr here with an early global view on Tuesday, July 22nd, 2014. It's currently getting to be 7 a.m. U.S. Central Time. And on the short-term view, we've got the S&P 500 hourly on the left, 30-minute on the right, with indicators below as usual. And this is very interesting because in spite of all that weak data, it is up about $6 back up into the 1972 area. Now you recall this only gets it back up toward the gap back up at 75 to 76 and a half, and the previous high we'll look at on the intermediate term chart up at 78, which it got very near Wednesday morning on Janet Yellen's upbeat implications from her very dovish expressions, continued dovish expressions. Of course, along the way, the market didn't like what she had to say about the reasons why the Fed was remaining dovish, and there was a good deal of weak data overseas. At this point, the European equities are actually trying to lead the way down for both the reasons of serial weak economic data as well as, of course, what kicked in from mid-morning last Thursday, which was the tragic downing of that Malaysia Airlines jetliner over the eastern Ukraine that led to the sharper sell-off back to the 1960, which remains an interesting support, as we saw yesterday. This upbreak from the previous Friday on the 11th that held in the wake of the initial Yellen comment sell-off, even held into mid-morning and lunchtime on Thursday before the market got down to the bigger supports we had noted down toward the 1950 area. And then 60 held again on the sell-off on Friday, even though it was an ugly gap lower opening. Whether or not it got below 60 was going to be important. But it is a bit of a ranging market, and back up at 72 doesn't really prove a whole lot. Only out above the old high at 1978, and ultimately the extension of the topping line and oscillator resistance means there's going to be resistance up in the 1985 to 87 area should the S&P future decide to make a new high this week. And in terms of the indicators, of course, they're just kind of whipping around as the market's whipping around, and that pretty much does it for the short-term view of the S&P 500. Moving over to the intermediate-term view on the weekly chart on the left and the daily chart on the right, first thing we can see, looking at where the stronger market might get to, you can see how it's left a bit of a double top now, right up around the 1978 area, but even if it were to escape, this topping line is up to 1985, and with an 1852 41-week average, you add 135, the range is 130 to 135 over that for the next oscillator resistance, and that would be up into, of course, the 1987 level. So 85 to 87 is higher resistance. And as we look at lower supports, you can see the area down here, why the mid to low 50s is so important, because of the topping attempt from back in late June that the market finally gapped back above 1953 to 55 on Tuesday, July 1st at the start of the quarter, and that negated resistance has been good support. However, even if the market start closing below 50, there's key Fibonacci, fresh Fibonacci support at 34 that is a buffer below all of the previous congestion we had highlighted between the 1938 to 35 level, coming back down to this congestion the market left on the reaction back in June that we knew would be support late in the month, even though the market had given the temporary topping signal. And that's pretty much it for the S&P 500.